When you think of the SPY that tracks the S&P 500, at what point does it really become overvaluated and too expensive for really what it's worth? Now, this is a discussion that I had a little while ago with a financial advisor, and it was pretty interesting. And this is also an article that we've seen over on Seeking Alpha. Was when does the SPY or the S&P 500 Trust Index become too expensive? When you start looking at the high profit to earning ratio or the lower yield that it is offering as of right now, the current valuation, a lot of people have started to trim and really limit the exposure that they do have to the S&P 500, because when you start thinking of it big picture, a lot of the mega sized companies, the Nvidias, the Apples, the Googles, they are really driving the S&P 500, and also the value of the S&P 500 is just going through the roof. And even when you think of the entire market itself, the S&P 500 makes up about 80% of the index itself, meaning that when you look at some of the more exposure to those mid caps and those small caps, it might be a little bit better, and it might be ideal to go through and break it down. But in today's video, we're going to be specifically looking at the SPY and really looking at some of the reasons why it seems to be overvalued. When you look at liquidity and when you look at the trade volume, the SPY is the absolute dominating one that we see. Looking at the chart right here, the average daily share volume is around 59 million shares a day, even in comparison to the VOO and the IVV, which are roughly about 5 million shares on a daily average share volume. Now, when you look at the SPY to the VOO, this is where it becomes really interesting, because when you start looking at the price, the SPY is almost $550 a share, where the VOO is $500 a share. So about $50 more with that SPY. And then of course the IVV is around that $550 as well, making the VOO seem like a pretty good discount, because remember, the VOO is tracking that same exact S&P 500 index. And that might even be the reason why Warren Buffett said to buy the VOO instead of going into, some of the other index funds that we see. Now, of course, when you start looking at the profit and earnings ratio, this is where it gets pretty interesting. The fund trades at a profit earning ratio of 22.75x. You're almost 23x what it is, even though they're the assumption of the double-digit EPS growth rate, which they're kind of expecting over the next 2 years. The price and earnings ratio they're saying is going to be almost 30x what the actual value is. And again, is it going to be worth it? So that's where a lot of people are getting skeptic when you start looking at the double digits that we're seeing within here. Really, how long can it hold on without there being a market correction? And a lot of people are saying we could see a market correction that could be in the range of 10 to 20% when you start looking again, kind of the overvalued S&P 500. Now, my thought personally is when you start looking at the Federal Reserve, and this is again kind of the big picture thinking, is if you take the Federal Reserve and they start lowering interest rates, that means we're going to see a lot of lower interest rates on CDs. We're going to see the high yield savings accounts slowly go away. We're going to see the rates on bonds going to go away. That means a lot of the money that we see within there with, again, the rate reduction from the Fed is going to start moving into stocks. It's going to start moving into cryptocurrency. We're going to start seeing it move into other investments because the rate is no longer going to be there because of the adjustment. Now, of course, when you start looking at some of the very similar index funds, we talked about the VOO and the IVV, but I do also hold the VTI. Now, out of these two, I do personally hold the VOO and the VTI, and I like the exposure between both of them, with the VOO again being much cheaper than that SPY, but also looking at the VTI, which is the Vanguard Total Index. This is the one where it is kind of interesting because, again, you're invested in the entire stock market, not just in the S&P 500, which means you do have an exposure into those mid caps. You also do have an exposure into those small caps, which again, I really do like. Now, when you start breaking down the SPY, and again, thinking of the valuation metrics of kind of how it's trading, but also looking at the dividend yield. So looking at the dividend yield from the SPY, it is 1.23, which is 16% lower than its 4-year average. So we are actually seeing the dividends go down, which again is a confirmation of the overvaluation of it. Now, we are seeing this exact same trend, of course, with the VOO, with kind of the overvaluation, while the VTI is less overvalued overall because, again, having that exposure to those mid caps and those small caps. Now, when you start looking again at the comparison of the risk-free rates, so what we mean by risk-free rates is when you're looking at the comparison of bonds where it is a guaranteed return, and looking at bonds with 10-year treasury bond is around 4.5%. The SPY's premium evaluation suggests limited future excess runover of the bonds, which again is kind of a market bubble condition. And again, this is a lot of information that is over on Seeking Alpha and where I grabbed this article from because it's super interesting. And anytime I see that the overvaluation, or really the downgrading is what they're calling it, it says the SPY rating downgraded due to the overvaluation that we are seeing. So when you start looking at what can you do, not only the overvaluation of this fund itself, but what can you do to kind of go out in really looking at something that is kind of a similar fund, that would be putting more money into the VTI, not only having a lower fee, being less overvaluated, and also the VU or the VEU, which offers some international exposure and treasury bonds due to the really favorable outlook, again, with some of those rates coming down. Now, me personally, this is my personal opinion outside of the article. I do not invest in anything international. I do not invest into anything that is bond related. When you look at bonds, even when you look at the 10-year time frame, with bond return is roughly about 2%. Even if you're in something that is overvaluated or really an overvaluation, if you're looking at something like the VOO, which has a 9.9% annualized return over the last 100 years, you are going to get a lot more growth out of the VOO, where I know a lot of people do look at the SPY as a very similar. But again, it seems like the price ratio of almost $50 cheaper per share with that VOO is really going to make a big difference. Now, of course, value stocks. This is the other one when we talk about Warren Buffett. He is really invested in value stocks, and he always says to look for some value stocks. So when I think of my HD, a majority of the companies that reside within an HD, which we know is a dividend ETF, are of a very, very high value. So it is kind of a different structure and it is kind of a different build, which is the reason why if you caught my video on the 3-fund ETF portfolio, it is really the ideal way to do it, which of course, the majority of it is focused on the growth aspect. So when you look at those large tech companies, that is where a majority of the portfolio is really focused on. Then we have the core, which of course could be the VTI, which I do hold, the VOO, which I hold, and the SPY, which again, they're saying is very overvalued. And then of course, the third segment of that is breaking into that dividends. So looking at the VYM, looking at the HD, looking at the JEPI, there's a couple different ones that essentially that you can go in there. They even mentioned in here the ProShares S&P 500 Dividend Aristocrats as a high yield alternative to not put so much in the SPY. And again, thinking of this in big picture terms, investing into the S&P 500, even if you're holding in the SPY, it is really, really important to hold something like this that is going to be invested in the S&P 500. But overall, when you think of this, maybe not investing as much as you could put in there, even maybe trimming a little bit of it for the diversity aspect and putting some into some other places, especially while the market is hot. I mean, we have seen record highs again and again and again over the last couple of weeks and the last couple of months, which is kind of crazy, really driving the market. And of course, like I said earlier, at what point is the market so overvaluated or seeing such a rise that it is more difficult to get into because everything is exponentially more expensive? And it seems like that's what we're looking for and possibly could see with everything in the Federal Reserve and the tech bubble or the tech, the stock market correction, whatever you want to call it, whatever's going to happen with it. Make sure that you're investing on a consistent basis. We've seen ups and we've seen downs, even looking at, 1999, looking at the housing market crash, looking at COVID. We have seen ups and downs with the market, and it always does come back, and it always comes back really, really strong. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.